Hey guys, Taylor with GammaEdge here, coming at you with a market recap for April 21st, 2025. Obviously, big sell-off in the market today, a little bit of rally into the afternoon. Let's get into pre-market prep and how the intraday tools could have kept you on the right side of the trade. All right, so first thing we do, pre-market prep, always starting with our market trend model. What is the market trend model? It's our way of gauging trend and momentum in the underlying market. With that, we use the tick index. If you're not sure what that is, you can go Investopedia it real quick. But essentially, it is tracking real-time buying and selling across the major exchanges. If there's collectively an uptick, it's going to move higher. Collectively a downtick, it's going to move lower. What we do is we string that together to create a time series so we can understand not only intraday trends, but multi-day to multi-week trends. That creates what we call the cumulative tick. It's this bolded white line here. So again, you can see that this is a 5-day look back period. So pre-market, this is what it looked like. We were just saying basically a big choppy range. Nothing to be super bullish about here. Yes, on Friday, we did get a little bit of intraday rally throughout the session. We got some filter tick buying. Filter tick buying is a way that we gauge large buying and selling based off of large tick transactions. So again, when this is moving higher, that means that there is significant buying happening. And when it's going lower, it means significant selling is happening. So the thing that we noted is, yes, on the very immediate term, trend did shift slightly higher, but just note in the context of what's been happening all last week, we are still in a boxed area. So as we've been saying, since like the beginning of February or whatever it was, bulls are guilty until proven innocent. So we have to respect the signal that, yes, a little bit of an impulse higher, but we are really not looking for reasons to get long in this market. Reason for that is looking next at the SPX option structure. If you're not familiar with that, what we do is we want to understand what is happening in the underlying options markets. Reason for that is because A, they are huge. B, that's where a lot of the speculation is transacting these days. And C, it is inherently forward-looking. So by understanding what's happened in the options market, we can understand what the future expectations of the speculators are. And when specifically we focus on the SPX complex, because that's the largest, most liquid options market that we can observe. And this gives us a great idea for what the kind of general market sentiment is. So again, there's two components to the SPX complex. There's SPXP, SPXA, SPXP, which is visualized here. You can think of this as kind of the cigarette boat. This is where your shorter term traders, this is where your daily, your weekly, your zero DT expirations reside. And what we can see here is that we are in a put dominated environment. And by that, I mean puts are dominating above and below spot price, as opposed to a call dominated environment, which during a more kind of tame market where we see just gradual price appreciation over time. That is certainly not what we have here. Just note the amount of red that you can see. So again, kind of a range bound market trend model, SPXP, the short term SPX complex put dominated. Then when we move to SPXA, think of this as the cruise ship. Reason it's a cruise ship because this is where your kind of longer, slower moving institutional capital is positioned. This is where your monthly and your quarterly expirations reside. And again, it's also much larger than the SPXP complex. Again, this is put dominated structure as well. Again, above and below spot price is put dominated. And just a quick plug for you guys. So yesterday, Sunday, we released a newsletter article which covers our market turning framework. And what that is looking for the signs of when a market is shifting from bearish to bullish foundation. And so it starts with the market trend model moving higher, then it goes to the SPXA, SPXP complexes going from put dominated to call dominated, and then price starting to move above our transition zones, which are kind of key levels, key zones within the options complex. Very relevant topic right now because of what price action has been doing. Just confirmed today where we saw a failure to go higher. And so if you didn't get a chance to read this, we'll leave a link for you to sign up for the newsletter in the YouTube description below. The reason why that's relevant is at least from a swing trader's point of view, just understanding the environment where we were in. Clearly right now, not a good environment, market trend model. Sideways, this is all from a pre-market point of view, right? Then both the SPXA, SPXP are put dominated, so that tells us not a good time to be putting on kind of longer term positioning and expecting price appreciation. So then what we do after looking at SPXA, SPXP full complexes, we then zero in on SPX 0DT. Reason for that is because, the first thing that's going to change is the 0DT complex along with the market trend model. And then also SPX or SPX 0DT can just trade independently of kind of what the broader market forces are saying, just given positioning for the day. So what I mean by that is, yes, SPX-A, SPX-P could be put dominated, but SPX 0DT structure, we could be trading above key levels that could make sense for it to move higher. So that's the reason that we focus on this independently. The other reason is because, 40-75% of all volume takes place on the 0DT complex. So it's kind of its own beast, right? So it makes sense to analyze it on its own, then monitor those intraday volume flows intraday as well, which we'll get into because it had a big impact on price today. So anyways, no, I rambled a lot there, but long story short, we are put dominated above spot price, call dominated below spot price. That's the normal structure. Not a lot to say there. The one thing I do want to say is transition zone was 5,300 to 5,305. You can see that we opened quite far from the transition zone. I forget where did we open today? 52.15, something like that. So the rubber band was quite stretched. The other thing we noted here is we noted those strikes that had significant speculation there, and then we had major air pockets below that. So opening the day, we opened between 52.50, 5,200. So there's just a massive air pocket. By air pocket, those are important because that's where your intraday volume is really going to impact the movement of spot price, as opposed to kind of market maker and moneyness of options per se. And again, the way structure was this morning, it was really just focusing on those half levels and the whole levels. Whole levels meaning those, 5,200, 5,100, then half being 5,250, 5,150, stuff like that. So getting to actual price action today, again, we could just see pretty much just a grind lower all session, got down to 5,100. I did see a little bit of a reflexive move higher, like 50% retrace or whatever we were talking about in this area. Being careful not to get too greedy to the short side, just because we weren't seeing material downside speculation at that point. And 5,100, that's a big move lower on the day. But price action is great, but looking at what the tools were saying. So first off, looking at the market trend model, intraday, it can be a very valuable tool, right? The cumulative tick, we were just trending lower all session here. Filter tick, again, significant selling. Linear down day there as well. By linear down day, we just mean that's just kind of a 45 down degree signature, just consistent selling throughout the session. So that was kind of the first tell where wanting to get long, right, is just not the play, because we were just selling all day. So at that point, it's just kind of finding a level to trade against, or kind of whatever your trading strategy is, understanding what the trend of the day was. Very, very helpful. This tool is helpful in understanding the character of choppy versus trending price action. Today was, the forces under the hood were clearly selling all session. And then the other valuable tool that we utilize every day on an intraday 0DT basis is what we call vol-M. It's intraday volume analysis. What we are doing here, specific to SPX 0DT volume, we are looking every 5 minutes. We aggregate the distribution of call and put volume. We find the middle points of those distributions, which is called a centroid, and we plot those centroids every 5 minutes throughout the session. So again, every 5 minutes we plot those, then we connect the dots, and we create this bolded green for calls and red for puts line. So what that tells us is at any point in time from the open to say noon, we can understand, okay, if the centroids are trending lower, all else equal, we can expect that behavior to continue throughout the rest of the session. And so what that does is, A, that helps us characterize price action in terms of trending versus chop, and B, that helps us understand kind of, again, all things equal, what the likely path of price could be throughout the session. And so we will get into kind of how this is useful, because this is the end of day snapshot, but still we can see, again, the put centroid side was, sideways to lower. Call centroid side was decisively down throughout the session. So there was no upside speculation higher. So that made it really easy for us. Pairing this with the market trend model to tell us, okay, looking for some big bull move higher just was not in the cards today. Looking for more downside was the prudent play. And so whether, you're a credit spread seller type trader, selling above and below the centroids, or, just understanding that the market is generally down, so selling call spreads, or, you're a directional trader, futures trader, zero DT scalp or whatever it is. Again, just understanding what direction the market is trending on the day is obviously very helpful to know. And then again, just wanted to hit on here what we were calling out around 2 o'clock was as we were approaching 5100 is not to get too greedy. Reason for that is because we weren't seeing a big waterfall lower in the put centroid side. And again, price doesn't go where transactions are not transacting at SPX 0DT. So if we are not seeing, a material downfall, then we should not be expecting, materially lower prices. And 5100 was a key level on the SPX dashboard. Again, just going down here, keep in mind this was the pre-market view, but 5100 was all the way down here, significant speculation at that level. So it would require a lot more put speculation below that spot price to really push through that level. Because again, you just got to think too, when we settled around 5,300, whatever it was on Thursday, and we gapped down to 5,220, then we progressed all the way down to 5,100. All of these puts are now in the money. So that is like a significant shift in those deltas, and a lot of monetization was eventually going to happen before the close to lock in those profits. So as we were getting further into the session, closer to the close, we weren't seeing that material downside speculation via vol M, and we were seeing that kind of wane in the rate of change of selling in the market trend model as well. That just kind of made it a no-brainer. Like, hey, getting greedy to the downside at this point probably is not the prudent play. The reason for that is the risk to reward, the amount that you could be making to the downside versus the risk of, a 50% retrace back to the upside, which would be completely rational or reasonable, I should say. That just is kind of the thought process behind that. So again, lastly, just going back to vol M real quick, showing you how this is useful. So this is what the view of vol M looked like at noon today. Again, we could see put centroid or call centroid trending lower, put centroid trending sideways to lower. So again, this is where I come back to what the beauty of the centroids do is, again, understanding what that character has been from the open to noon. We can then project what the likely path of price is, assuming all else equal. And if the behavior changes, then we are going to see that manifest in the future centroids that have not plotted yet. So again, at noon today, this was telling us that price was likely to trend sideways to lower. The market trend model was telling us the same thing. Noon is right here. Again, we were decisively lower, seeing filtered tick selling as well. So again, that is just the useful way of how we use this. And then something else that's cool to do is at the end of the session, what we do, come down, just look at this GIF here. What we're doing here is we're stitching together all of the vol M's because we produce those every 5 minutes, right? So again, we can just see that call centroid was obviously just printing down all day, put centroid printing sideways to lower all day, and then look kind of starting at 2 p.m. how, things really just start to flatten out, starts to rise a little bit. The rate of change of that is changing. And then that's kind of, again, where the thought process of not getting too greedy to the downside is. So hopefully that should make sense now about how we, go through our pre-market prep to understand the conditions of the market, where momentum is, where those key levels are at, and then taking that intraday and using our intraday tools to kind of navigate the price action. So with that, don't forget, we'll link to that article in the description. Just sign up for that email distribution list. You'll be getting those going forward, and you'll get access to all of the prior ones as well. So have a great night, and we'll talk to you tomorrow. Thanks. Bye.